Hi, everyone. I'm Mrs. Marinas. I'm a business teacher at Naperville North. Some of you have had me before. Some of you know who I am. Some of you have other teachers for consumer. But the consumer teachers and I are going to be tag teaming this unit a little bit. So you might hear from all of us at some point. But I'm going to be kicking off the credit unit during this time of remote learning. So I hope you're all doing well, and I hope you are continuing to learn. This is a super important unit because there's a lot of content in this unit, but I think you'll find it really interesting. It's really important for you to learn all of this and be aware of this as you head into adulthood and start making those financial decisions that really will impact your future. So if you have me, I'm going to move this little screen share thing over here. If you have me, you know I use Google Images a lot. Maybe your other teachers do as well. But I found an image that really exemplifies why this course is so important. We're not going to get into credit scores at this point. It's going to be later on in the unit. However, this category score table really shows the importance of understanding credit, why it's important to try and keep that credit score up. And it really kind of lays out the people in the country as to where they fall into a category in regard to good credit, bad credit. So if you look up here at the top, excellent and good and maybe a little bit of fair, this is about half of our country. Half of our people who actually have a credit score fall into a pretty decent range. So that's good news. However, the bad news is that half the people in this country are down here in the fair, poor, and bad. And that's not good because it's not good for them. It's not good for the country or the whole economy itself, because you look at people who are paying way more for things than they should, and they just get deeper and deeper into debt, and it's just not good for them in their life. So the goal is to stay up here, and hopefully the knowledge that we impart to you will help you do that. Okay, so the next slide, this I'm going to actually explain what credit is. So credit is like if you want something that's kind of expensive and you don't necessarily have the cash for it, you may consider taking a loan out for it so you could have it today, but it's with the promise to pay it back in the future. And usually that promise includes interest. Okay, so you'd be signing a contract and getting into some form of legal agreement with a company saying, yes, we're going to pay this back. It may be monthly, and it will probably most likely include interest as well. Okay, let's take a look at where we can get credit from. Okay, the top you're probably familiar with. Some of you might even have a credit card that's co-signed with your parent. So credit card companies offer like Visa and MasterCard, American Express. Those are general credit cards that you could buy anything with, really, that companies that actually take credit cards, you can just swipe that and buy it. But there's danger in that too. We'll get to that in a little while. You could take a loan out from a bank, like a line of credit. You could possibly get a line of credit to buy a car, or maybe do some home improvements, or maybe even start a business. A lot of people do that as well. Down here, we've got automobile dealerships. So a lot of people get loans from auto dealerships when they can't afford to pay cash for a car. Okay, that's sometimes people overspend there, so that's an area we'll be discussing as well. Student loans. This is probably very real to a lot of you, thinking about, how am I going to pay for college? Do I have to take out a big loan to pay for this expensive school? Or should I go to a school that's maybe less expensive or consider community college? These are all decisions that you'll be making. So definitely the government offers government-backed loans for you to go to school. So that would be something you might consider in the future as well. And then there's also private mortgage companies, which I've hyperlinked right here. And so if you click on this, I'm going to do it now, but these are companies that offer loans out to folks who want to buy a home. And that's probably something that you're going to be doing possibly in the future. Now, I'm going to talk about this. I thought about taking it off, but I'll leave it on there. So if you see this someday, you'll know what this is and you'll know to keep driving and not stop there. But payday lenders they're legitimate businesses. They are legal, but it's when people know they're going to get paid, but they need the cash today and they haven't gotten paid yet. So they might go to a payday lender and say, hey, can you give me an advance on my paycheck? And a lot of times those companies are charging 3, 4, 500% interest on paychecks. It's crazy. So I would definitely stay away from payday lenders. And if you owe somebody money and you haven't gotten paid yet, try to work it out with the person you lent it to. Hopefully you're not in that position, but definitely stay away from payday lenders. Not good. All right, another one I'm going to talk about, and I also have that in orange too. It's not that bad, but stores also offer credit too. So you might have been offered a credit card um, from like Kohl's or American Eagle. They might say, "Oh, I'll give you 10% off your whole purchase today if you sign up for a credit card." That's because they want you to have credit with the store, and within the likelihood that you won't pay back everything you charged and they'll make money on interest. Generally, those aren't great to have. If you're going to charge something, I would just stick with one credit card and then pay it off every month instead of having a bunch of different credit cards and kind of forgetting what you have. But stores love it when you sign up. That's why they encourage that and they ask that every time. I think the employees are made to say that. Even if I'm going to save 10%, I generally say no. That no, I don't want your credit card. I'm good. So, but again, life is full of choices and the choice is yours. Okay, so let's take a look at a typical loan. So if you in the future, if you buy a car, chances are you may get a car loan. And you know what? That's okay. It really is. I mean, it's probably better to pay cash for a car ultimately, and someday you might be in a position to do that, but you may be getting a car loan. So this is how it works. Let's say you get a car and you have a down for $15,000 and you put a down payment of maybe 5,000. You might get a $10,000 loan from the car dealership, and they are loving that because car dealerships actually make a lot of money on loans from you. Sometimes they make even more than the markup on the vehicle. So they're very happy when you say you want to take a loan out for the vehicle. 8% annual interest rate is probably pretty typical for for someone who's young, hasn't really established credit yet, and is just kind of it just has a job for the first time. So this might be you once you get out of school, going to a car dealership. 8% is probably typical that you'll pay. Um, and you might get into a monthly payment for 3 years. But however, this is the part I want you to look at, because if you think about a car is a depreciating asset, which means it does not retain its value. In fact, it goes down in value. So the fact that you're paying $12,000 more present value for that car than it's actually worth is not really a great financial decision, but sometimes it is necessary. So you have to weigh it, see if you're going to be able to afford the car payment, and see if you're okay with paying that type of interest. But a lot of people do. Just want to make you aware of that it's out there. Okay, so let's talk about the pluses and minuses in establishing credit. So here's the plus side right here. Credit's okay. I'm not saying it's bad. You just have to be really careful with it. So it is an effective tool, like it says on the slide, if it's managed responsibly. So you want to consider the interest rate. All right. You don't want to have a really high interest rate because that means you're paying more for the product than it's actually worth. And consider what you're buying. Are you taking on a student loan, maybe $5,000, $10,000, $15,000 to fund your way through school? You might think, oh, well, I'll get a good job, and I can pay it off later. And that you might be absolutely right. So if it's worth it for you to do that, it's an education. You'll probably make more money if have some type of a degree, possibly, not always, but most times you might. You might say, you know what, it's worth it. So also, you might consider Can you save for it? Can you make a decision to say, you know what, I'm not going to take a loan out. I'm going to wait and I'm going to pay cash at a later date for it. But these are all personal decisions that you have to make. Or can you actually get a job and work more and then pay cash too while you're saving for that car, while you're going to school? Can you pick up extra shifts? Can you pick up an extra job on the weekends if you're working during the week? All decisions that you're going to be making. So the bad part about credit is that it can create a lot of financial stress. So if you owe a lot of people a lot of money, and you don't have the income to cover it, that is a very stressful position to be in. That can impact your personal life as well as your financial life. Um, and it just doesn't make things good for future decisions, future choices that you want to make. Okay, so it's just managing it and being careful. All right. Um, Something else you might think about, does the loan provide long-term benefits? Like, are you going to benefit from taking out this loan, a couple years down the road when you're still making payments, maybe 5, 10, 15, 20 years down the road if this is a home? Um, this is something you might want to think about with student loans, because if you take out a lot of student loans, it may take you years and years and years to pay it back. So just something to think about, and evaluate whether or not you want to take on these loans or this financial burden. Um, so you might want to think about is investing in yourself with a small education loan. Do you need that? Sometimes people say yes, and that's okay. Purchasing a vehicle to get to and from work. A lot of people say, well, yes, I need a car, but do you need an expensive car? That's the point. Can you drive around in a cheaper car, or do you feel like you need a more expensive car? I have friends who are realtors, and they need a nice car because they're driving around clients, and sometimes they like to lease a car. We talked about leasing. There are good points to do that. So it's all a personal choice and weighing the benefits. Um, and then the last one is, sometimes people say, I've got to have a credit card to make an online purchase, like to reserve a hotel room, for emergencies. It is so convenient to have that. So the point is, yeah, sometimes it is good. I have a credit card and I do use it. But I do pay it off every month. I don't try, I do. So I don't have debt in that way. Okay. And I think we actually just went over all this. So should you use your savings to make the purchase instead of charging it or taking out a loan? That would be a good thing to do. So save first and then make the payment. But a lot of times for the larger purchases, you can't do that, like a house or maybe even tuition. You might want to ask yourself, can you wait to purchase the item if you've saved enough money? And that the advantage of paying cash is there's no contract to pay back money, there's no interest or fees, you're not indebted to anybody, and you're not spending future income. Because when you pay interest, what you're not doing is taking that money and investing it in your company's 401k, into an IRA, into the mutual funds that you will need later on to retire in a good place. So if you think about it, if you're paying extra for items now, think about what the opportunity cost for that money, what that is, because you're not investing in your future when you're giving it to someone else. So just some things to think about. Okay, let's talk about overall some general types of credit. So closed-ended credit is a loan that is for one thing. Like if you bought a car, you would get a loan for that, possibly, but you couldn't use that line of credit to go buy, I don't know, to go buy a house or to go buy another car. Okay, so that loan is specifically just for that car. And you're in a contract saying that you're going to pay a certain amount of payments along the way. So the examples here are a mortgage, the automobile loan that we talked about, the personal loan. okay, like a line of credit or a student loan. So the monthly payments, this is what they would look like. They would be the same every month. The interest is built into them. And you can certainly pay them off earlier and throw that extra money at the principal, and that would be great, and that'll save you interest later on. So you're not, you typically, you wouldn't be totally locked in into those payments with an option not to pay off early. But I would call the lender and see if that would be possible. If you want to pay, say these $300 payments, say you had $1,000 and you wanted to go just toward principal, give them a call, see if you can do that, and see if you can pay the loans off early if you have the money to do that. It's a really good thing to do. Okay, so that was closed-ending credit. This is open-ended credit, and typically this is a credit card. And a good example would be a credit card. This means that you charge stuff and you pay it off. You charge and you pay it off, and you can buy a variety of things. It's not just one thing like the car loan or the mortgage. Okay, so it's a series of payments, and typically they make you pay a minimum payment, which means they charge maximum interest because the balance has the interest charged toward it. So you do have the option when you have a credit card to pay it off every month and to get like a short-term free loan, because if you pay it off, they will not charge at the end of the month, they will not charge you interest for a credit card. Um, but where people get into trouble is they just pay the minimum payment, and then they get charged interest, and then their interest gets charged interest. And that's where people get so out of control that sometimes bankruptcy is the end game there. So when you obtain credit, typically you'd have to fill out a credit application. And you might think it's invasive, but actually the more questions that you can answer, and if they're good answers, like for instance, do you pay your bills on time? Do you have good character? Do you have capacity to pay? Do you have a decent income? Do you have assets that you own outright that you could actually cash in to pay off the loan in case you weren't able to anymore? Those are all things that lenders will take a look at. And if these are all good answers, if you're a good credit risk, you typically would have a lower interest rate. So that's actually a really good thing. That's how people with good credit pay less for their items, because they pay lower interest rates. Okay, so an annual interest rate is actually stated as an annual percentage rate, or an APR. Okay, so that's something you want to take a look at. Is it a low interest rate? Typically, I think mortgage loans right now for a 15-year loan, they're hovering at around 3.5%, which is pretty decent. When I was growing up in the 70s, they were so high, they were like 14% interest, huge interest rates. But you can buy a house now and get a pretty decent interest rate if you have good credit. Something else you want to take a look at are fees. So if you have a credit card and you don't pay it on time, a lot of times you'll get slapped with a $35, $40 late fee. And if you go over the limit, you could have an over the limit fee. So these are all things you want to look at, because life isn't perfect. People make mistakes, and you just want to be sure that the fees don't eat you up. Okay. And I think that's about it on there. So when you're looking at a contract, you want to take a look at it either online or on paper, and circle or highlight the items that are potential red flags that could trip you up, maybe get you into trouble. Never sign a contract unless you really think it's good for you, and maybe have someone else read it as well. So these are the terms of credit that you want to take a look at. The interest rate for sure. Thinking, if you take out a student loan, you want to see what that interest rate is going to be, and also fees, late payments, and a lot of other things. So you got to look at all those things, kind of weigh it out. Is this something you want to enter into? And I would not take those things lightly. This is adult stuff. This is important. These are important things that you're going to have to consider. All right. So really, this whole unit is to make sure you understand all your responsibilities to be an adult borrower and to be a good financial steward of your money. Um, and just to consider, like, in your future, what the implications will be if you do take out a lot of loans. You're going to have to pay them back. That's the thing. People don't think about that. You think about, oh, okay, well, I'll just take on a loan and it's not going to affect my life right now. And it probably won't. But 10 years down the road, when you're on your own and you want to enjoy your life and have choices, it could be impactful. So it's good to, like, kind of look ahead, look into the future and say, what kind of a life do I want? Um, so that's the whole idea behind this unit. So there's, again, I don't want to paint a terrible picture of credit. I think it can be used responsibly. But it's just, the whole point is to just we want you guys to have a really good financial future and to start thinking about these things now. All right, well, thank you, have a good day, and I hope everything's going well. Take care.